A very good morning to all of you students. My name is Divas Gupta and today we will be discussing to better specific loan would have given to Mr. A the loan amount. A has promised to pay to the bank some cash flows in the form of interest and principal, and Mr. A would have got initially the home loan amount using which Mr. A would have purchased the home. Now if we go and talk about from the balance sheet, we have equities and liabilities, and here we have assets, right? So the loan that bank has given to Mr. A would first of all stand where? So students, you can unmute and respond, or even you can type on the chat box as well.
On asset side. Loan will
Yes.
be on the asset side.
Perfect. So the loan that bank has given to Mr. A will sit on the asset side, right? So let's say here it comes that home loan given. Okay. And similarly, there will be equity here, the contribution to the from the shareholders. Then there will be liabilities in the form of deposits or in the form of savings that the bank would have accepted from the public at large, right? So let's say this will include the fixed deposits, recurring deposits, even the savings bank account. Whatever has been given by the public at large to the bank will sit in their liability. Now if you see that the primary objective of bank is the lending of money and accepting the money, right? Accepting the money in the form of deposits, in the form of other investments, and lending the money in the form of various different avenues of loans available, right? So if this bank were to, be in the business of lending, and this bank is ended up having only one loan given to Mr. A, then do you think that the bank would ever be able to grow? The answer is no, right? Because here there is a limitation. Let's say the bank would have accepted some 100 crore rupees and bank has already given a loan of 100 crore rupees. That's all. The earning potential of bank is limited here, correct? The business growth will not come to that bank because ultimately that 100 crore corpus, whatever is available with the bank, will only be available for the bank to be paid as a loan. Now here comes the concept of securitization. So securitization is basically converting your illiquid asset. What is the illiquid asset here for the bank? The illiquid asset is the home loan that the bank has given for 25 years, right? By illiquid means that although the EMI will be serviced on this loan, but for a long-term basis, the funds are committed, right? This 100 crore is committed for a long-term basis. So the bank is treating this home loan as an illiquid asset and it is actually converting it into securities. I will explain you how. I will explain you how in the further steps. So this process of converting the illiquid asset, right? We will keep on adding different elements to this conversation. Now, first of all, here we introduced a term called as marketable securities. What do we mean by that? And what is the process of this conversion? How can we really convert this illiquid asset into marketable security? So this is something that we are going to discuss now. Okay. Now, I'm just coming back to this balance sheet itself. Let's say bank here is paying an interest, let's say at the rate of 8%. And here on the loans that the bank has given, the interest earned is, let's say, 9%. Okay. So what is happening that the bank is able to only earn 1% on the entire funds that is available with the bank in terms of the process of lending and accepting the money, right? Now, if I may tell you that securitization is one process by which the banks can expand, but yes, there are other ways through which a bank can also expand, right? Because some of you might be thinking that why can't bank increase the acceptance of deposits? Maybe the bank could accept another 100 crore and hence the bank will be able to give another 100 crore of loan. Risk increases if your liabilities are also increasing, your debt equity ratio will also go for a toss, and similarly your other statutory ratios also gets impacted. So securitization is seen as a very lucrative process by the banks to expand and to monetize on their illiquid asset. Okay. Now, see, this is the process. Let's talk about these illiquid assets, which are in the form of which are in the form of loans. What will bank do? Bank will sell illiquid assets. Can we sell the loan as well? The answer is yes. You can sell any of your receivable. So ultimately, your loan is something that you have a contractual right to receive from Mr. A, right? If I talk about the bank in Mr. A's case. So can you sell that receivable? The answer is yes, you can sell that contractual receivable. After selling the contractual receivable, whatever EMIs are going to come to bank will actually belong to the entity which have purchased this illiquid asset from the bank. I hope you're able to get my point. So whatever future receivables will get generated or the future cash flows will come on these receivables will be kept by the entity who has purchased this illiquid asset. It will not be retained by the bank. Okay. So this is selling the illiquid asset. After you sell the illiquid asset today, you realize funds. So this is all what bank is doing, right? So bank has given a loan. Now it is selling that loan. After selling that loan, it is realizing the funds. After realizing the funds, it will further do the lending of such funds. And this cycle will continue, right? So the next step will be lending of such loans, such funds, sorry. So do you see with this limited 100 crore availability, initially the bank is able to give 200 crore worth of loan. Now, one of you may ask that why the bank is doing this securitization. What is there in it for the bank to do securitization? From a commercial standpoint, right? Because tomorrow all the cash flows will be going to the entity who have purchased this illiquid asset. So the answer is that the bank will keep some of the percentage with them in the overall arrangement. So as I said here, that ultimately bank is earning 1%, right? On whatever the bank is paying as an interest, and whatever bank is earning as an interest, bank is ended up earning 1% interest. So might happen after doing this securitization activity, the bank will retain 0.5% because the bank will have to share the net margin with the other entities who are part of the securitization process. But still, on another 100 crore, the bank will be able to get 0.5%. And then again, on another 100 crore, the bank will still be able to get 0.5%. So that is where some of the earning potential comes for the bank. So students, any question till now? Okay, let's move ahead then. Yeah. So if I if I again take the same case that we took and we will take it ahead to discuss about the securitization process now. This is Mr. A and the bank had given home loan to Mr. A and Mr. A promises to bank for repayment of principal plus interest. Okay, so this was the arrangement. Now, if I may ask you, what do we actually mean by loan? We say that bank has given a loan, right? So, what do we really mean by loan? And what does it entails for Mr. A and bank? What are the rights and duties of Mr. A and bank once we talk about that bank has given a loan to Mr. A? So, loan typically means it's a right from bank's aspect. I'm saying from the bank's perspective, right to receive interest and principal repayments. Okay, so if you will see loan from this lens, okay, you will be able to make out that there is a interest element and there is a principal element that we all know, but there is a contractual right to receive it. Okay, I'm further repeating this because this is the very basis of the securitization process. So there has to be a contractual right to receive something in future. Okay, because that's the benefit that the bank is expecting to get in future. And while some of you might know, this housing loan is also called as mortgage loan. Why? Because the house which is purchased through the proceeds of this loan by Mr. A has to be mortgaged with the bank, right? So that tomorrow, if let's say the repayment is not happening, then through that mortgage, the loan can be recovered. Now with bank, there will not be any single Mr. A, right? There will be many thousands of the borrowers, right? Who will be sitting in the bank's balance sheet in the form of a loan. So let's take all of them put together. So likewise, Mr. A, there are many, let's say, borrowers. In my case, I am assuming, let's say there are thousands of borrowers. Okay. And each borrower, let's say, have taken 1 crore loan each in 2000 for 20 years. Okay. So can I say that this is a pool of borrowers which have taken a loan of 1000 crore? The answer is yes, for 20 years. I'm just keeping it very synchronized just to explain. Although in reality, for some of them it can be 15 years, some of them it can be 25 years, some of them the amount can be greater or higher than 1 crore. But I'm saying while making a pool, I'm just saying that this pool is having 20 years of maturity and 1000 crore worth of loan. Okay. So this is what it is. There is Mr. A, there is this bank, right? Now, bank is actually looking at this pool of assets as a illiquid asset, correct? As we have already explained, why illiquid? Because the bank has committed these funds for a long term basis, right? And there is no realization that is possible in a short term outlook. Okay, so this is a illiquid asset. First of all, from the bank side, can we call them these as mortgage loans? Instead of housing loan, can we call them as mortgage loans? The answer is yes, because housing loan is also called as mortgage loan. So these pool of 1000 crore worth of mortgage loans is a illiquid asset. And let's say Mr. A is paying repayment here normally plus interest at the rate of 10%. I'm just assuming a number here, interest at the rate of 10%. Okay. So till here, I've just introduced the pool of these loans. Okay. Now, what will bank do? Bank will look out for a venture with SPV, special purpose vehicle. Okay. And with that SPV, the bank will say that I will sell you this 1,000 crore worth of home loans that I have given to the public. I will give you that, I will sell you that, and in return, you pay me 1,000 crore today itself. And you will have the right to receive future repayments and future interest receivable on this 1,000 crore. Clear?
Clear.
So, yeah. So, this SPV is actually formed with this very special purpose that SPV will accept all the loans that bank has given and SPV will pay to the bank. Now a question comes that from where this SPV will get the funds to pay to the bank, because the payment has to be done today, right? So can anyone, what are your thoughts, students? Come on. From where this SPV will get the funding to be paid to the bank? Any guesses? It's not about being right or wrong, it's only about being contributing to your thoughts. Come on, students.
It will also sell the right to somebody else.
Okay, so this is one of the thought that it can also sell this right ahead, whatever SPV has got from the bank. Chitra is saying from deposits accepted by SPV. Okay, I think briefly I touched in my discussion. Majorly, see, any which ways SPV can arrange funds from any of the sources, right? I mean, SPV can even raise an equity, SPV can even borrow a loan, right? SPV can do anything. Funding is available from any form. But the major purpose of this securitization itself is to create the marketable securities, right? This was the second element of the securitization process. So what will SPV will do? SPV will issue securities in the market. And what do we mean by security? Security, so equity is also a security, debenture is also a security, preference share is also a security, right? So with whatever legal form this SPV is made, mostly it is made in the form of a trust, right? So they will issue the securities which can be traded easily within the market. And some of the investors initially will invest through those securities. So that is where the SPV will be raising the funds. Now, who are those investors? Those investors are the ones who would want to invest for, let's say, higher risk, higher return, or at the same time, it can be low risk, low return as well, right? So those investors can be from many forms. I will take you through who are they. So let's complete this first. So the bank will transfer the right to receive principal plus interest, correct? And SPV will pay to the bank, let's say 1,000 crores today itself. And what will this SPV will do? Issue securities, okay, in different denominations, right? In a smaller denominations. Now we assumed in our case this was 1,000 crore of loan, right? So 1,000 crore of loan will, let's say, get divided into 1,000 units at the rate of 1 crore each, right? So this entire pool is divided into 1,000 units of 1 crore each. It can be in any denomination. I'm just taking an example. So now there are 1,000 units of a particular security that has been created by this SPV. Okay. And the moment this is created, it will be floated in the market with the people who would want to invest. Now, who are interested to invest in this? Where the surplus funds are there. Some of them are, let's say, pension funds, mutual funds, banks, institutional investors. Let's say banks for some time may have some excess funds which they don't have any avenues to invest. Maybe then they can also take it up, right? So these institutional investors or HNIs, right, high net worth individuals, it can be anyone. So they will be taking it up from the perspective of investing into that SPV and hence taking part in the entire process of the securitization. I hope this is clear now, students. So this is the very basic form of securitization. In this, again, we'll keep on adding further things. Any questions till now? Okay.
Would there be retail investors as well in this?
Yes, there can be retail investors as well. So these HNIs will be acting as a retail investors here. Okay.
Okay.
I'm just checking on the other question handle also if there is some questions. No. Perfect. So this is the process. Now, if I may summarize what we discussed till now, the illiquid assets have been converted into marketable securities, right? This illiquid asset was what? In our example, it was basis a pool of funds, the mortgage loan, right? And the marketable securities were what? These were issued by SPV denominated. So in various I mean in multiple units basically. Denomination was one only, which was 1 crore. This entirely is called as securitization process. Okay. Now there are two different terms: mortgage backed securities, asset backed securities. Can anyone attempt to say what will be the meaning of mortgage backed securities or let's say asset backed securities? Just a simple attempt. I mean, it's not that, yeah.
The mortgage-backed securities would be the securities issued where there is a security of the home loans.
Correct, correct, correct. Yes. So, yes, you're right. So, basically, this entire process of converting these marketable securities from illiquid asset is called securitization. Now, if this securitization is happening for mortgage loans, right? So, ultimately, these securities that have been issued are backed up by this mortgage loan, by these mortgages, right? So what, let's say what was happening, we have taken thousand of the borrowers, right? They would have taken thousand homes using the home loans. All those thousand homes will act as a security, will act as a mortgage to these marketable securities that have been issued, and hence we will say that these securities are backed up by these mortgages, right? Because ultimately, if SPV is not able to realize, or let's say if Mr. A is not able to repay to the bank slash SPV after securitization, what they will do, they will realize the funds by selling the mortgage, and hence these securities have a proper backup from the mortgage side. So that's why these securities, in the securitization process, these securities are called as mortgage backed securities, which is backed up by mortgage loans. Okay. And let me tell you, students, this mortgage backed security was the biggest reason. I don't know if some of you would have heard about 2008 crisis, right, which was there in US. So this entire process of mortgage backed securities have led to that crisis. Okay. Yes, there were many people involved, there were many entities involved. So that was the, so because, because of these reasons, some of the reasons which we are not discussing now because of the time limitation, but this securitization process in this specific part was involved in that entire crisis. Okay. Then on the asset backed securities, there can be other form of loans, for example automobile loans. Sorry, there can be other receivables, right? It can be in the form of other receivables, or let's say the credit card receivables, because credit cards are also issued by the banks, and they, whatever is receivable on credit card can also be taken up from the securitization process. Okay, so these are the other receivables. So other asset backed security means that whatever they are backed up by with, right? So these are called as automobile loans slash other receivables. So these are the two different, types of securities that are there. Now there are specific terms, students. Okay, there is a term called borrower. There is a term called originator, and there is a term called SPV, which we have already discussed, special purpose vehicle for this specific case, right? So who are these borrowers, students? So these borrowers are the ones who are taking loan from the bank. Simple, right? In our example, we took 1,000 borrowers, right? They had taken 1 crore each loan, and hence 1,000 crore was the loan value, pool of funds. Now within this, how, let's say, the discussion might happen, or let's say what is the view here, about this 1,000 crore of the pool of funds. Let me explain you. And why we always keep on talking about the entire pool of funds. The reason is simple, because the risk gets diversified, right? If you want to sell a pool of funds, the probability of default, the risk of default goes down. Now, let's say while this transaction is happening from bank to SPV, right? So they will be really valuing it, right? What is the real value of this receivable? Is it 1,000 crore or is it somewhere less? What they will do? They will actually determine that what is the probability of default, right? So let's say they conclude that basis history, 20% is the probability of default. Okay. On that, 50% of the amount they will not be paying. You're getting my point. So 20% there is a probability of default that 20% of this 1,000 borrowers will not pay, and at the same time they will not be paying around 50% of the amounts. Clear? 1,000 crore into 20% into 50%. So this is 100 crore. So out of the 1,000 crore, 100 crore can go for a toss, right? This is what the bank has actually agreed with SPV, basis their historical trend, basis their algorithm, basis the market, basis the risk profile, basis the credit profile of these borrowers, right? Because everything is checked in the transaction, that what is the repayment capability of these borrowers, right? Because the repayment will actually depend on their repayment capabilities. So this is one. Now, who is originator? Originator is the one who originates the transaction. Who is actually originating the entire transaction? Originating the entire securitization transaction and the loan transaction is done by the bank, right? So the bank, in our previous example, becomes the originator. Originator is the one who sells their illiquid assets. Okay. Now see the kind of different arrangements that this originator will do with SPV, given the context that there can be a default of 100 crore worth of funds. So the originator will say to SPV that okay, there are two ways wherein we can deal into this. One, that whatever is the default tomorrow or whenever the EMI becomes due, if there is a default, then I will take the risk and responsibility for the default. You are assured on entire 1,000 crore receivable being received with you. That is what originator will say to SPV in one of the arrangement. In second arrangement, originator can say that whatever tomorrow happens, it will be to your account. If there is a risk, if I am not able to collect 100 crore, you will have to take the loss. Definitely, the pricing will be different for both the scenarios, right? For the first scenario, where the risk is with originator, SPV will be end up paying a higher amount because SPV is not assuming the risk of non-collections. In the second scenario, where SPV is expected to take the risk, right? In that case, SPV will be paying a lower amount because SPV will have to take into account such risks. Hence, there are two ways we need to look into this. One is called as recourse, second one is called as non-recourse. What do we mean by recourse? So in recourse, SPV has a right to get back to the originator in case there is a default. So let me explain it here. Recourse is basically which allows SPV to get funds from originator in case the borrower defaults. Okay. So the recourse means that there is a recourse available with SPV in case there is a risk of default. If there is an actual default, it can go back to the originator. Now, in this case, the pricing will be different, correct? Because the risk is taken up by SPV, sorry, by originator, right? So the pricing will be on a higher side. SPV will be end up paying the higher amount to the originator. In case of non-recourse, so in case of non-recourse, SPV will have no entitlement to get the funds back from originator. No entitlement to the funds from originator in case borrower default. So this is very similar to the scenario, students, where you would have seen that bills receivable gets discounted, right? And they get discounted on a recourse or a non-recourse basis. Clear? So this 1,000 crore in recourse basis will be borne by, sorry, this 100 crore. Now let me ask you this question. If let's say there is an actual default of 100 crore, this is the actual default that has happened by the borrowers. So who will bear this in case of recourse? Come on,
Bank,
students.
bank, the
Bank
originator.
will bear. Perfect. Bank slash originator will bear this because SPV will not have any risk to this. And in case of non-recourse, who will bear this?
SPV.
SPV. Very good. Yes. Clear? I hope till now the discussion is clear. Please let me know, students, in case any one of you have any doubts, clarifications, if you want me to take it up. Okay, let's move ahead then. Now let's introduce another parties to the securitization process. Yeah. So we discussed that there are borrowers. Let me first of all put the regular parties. Sorry, just a second. There are these borrowers. Then there were these originators. And then there is this SPV. Okay. Now, if you see, these were the major parties, and then below SPVs, there were these investors, right? Now, if you see that once the securitization has happened, the securities have moved. The loan has moved to SPV and SPV has issued securities to the investors. This is where the securitization has happened. But if we talk about 1 year from that, or 2 year from that, or 3 year from that, there has to be a agency who is responsible for managing the collections, accounting the collections, right, and making sure that the customers, or let's say who the borrowers, the people who are borrowers, they don't have any confusion in basically whom to interact with, right? So what will happen in such a case? There is a need of a new agency that arises, which is called as the receiving and paying agent. So they are actually responsible for collecting the money from borrowers and then remitting it back to the SPV. Keeping a tab, keeping an account of whose amount is due, what has been received from whom, right, and what is the overdue amounts. Correct. So these are called as the receiving and paying agents, and they play a very critical role in the overall servicing of the amounts. Clear?
Clear.
Perfect. Then, if you see from the investor standpoint, okay, now think it from the investor standpoint that the majority of the risk, or let's say the entire risk, is now shifted from originator to SPV to investors, right? So this is the chain. Earlier, the risk till the time securitization has not happened was sitting with bank. Now, after bank has sold it to SPV, the SPV assumed the risk. But what did SPV did? SPV also securitized the amounts by converting it into the marketable securities. Now investors are finally the parties who are assuming those risks. Now there has to be some level of comfort with such investors, because you cannot say that investors will be ready to invest in your SPV without knowing that what is there in return for them. Correct? So these investors will actually need a comfort that what is the quality or what is the credit rating of this loans, of this pool of funds that we are going to subscribe for, the securities that we are going to subscribe for, what is the quality of the underlying that sits in those securities. Correct? And can you tell me which agency will play a role here? Can anyone think of any agency which will do such sort of evaluations, whether the quality or whether the credit quality of that pool of funds is sufficiently good, bad, ugly, or what?
Credit rating agencies.
Very good. So these are called as credit rating agencies. Okay. So these credit rating agencies will actually have the responsibility to comment upon, or let's say to finally come up with what is their final evaluation on the credit quality of such loans, right? Of the portfolio of such loans. So If credit rating is good, investors will have good confidence for investing into this venture through securities. If credit rating is bad, the investors will. So some of the now it depends on a investor to investor, right? Some of the investors would want to invest with the expectation of decent return in a risk-free kind of a venture. Some of the investors would like to invest in a highly risky venture with the expectation also that they will get a higher return, right? So then the right set of investors can enter into this specific situation if there is a credit rating there. So the point that we are trying to say is if credit rating is good, so the risk is also low, and hence the return will also be low. If credit rating is bad, bad means it's downgraded. That means the risk will be higher. So if any investor is going to invest into this, they will expect a higher return. Let's say here the investor would be okay to get a 5% return, but here the investor would want at least 10% return to compensate for the bad credit rating, or let's say higher risk, right? So credit rating agencies plays a very big role in terms of these marketable securities being sold to the different investors. So two new parties we introduced here, students. One is the receiving and paying agents. Second is the credit rating agencies. And both of them have a very big role in the way the entire securitization process is run. Similarly, these SPVs are in the majorly in the form of trusts, and hence these will have trustees assigned to them. So, who would be responsible for the overall governance or functioning of the SPV? Clear, students? So, we are going step by step. Now, at least our understanding on securitization is quite evolved with the fact of knowing who are all the different parties in the entire securitization process, students. We can take our discussion ahead from this. Okay. So now let's move ahead. Now let's talk a little about what are the different instruments available for securitization. Yeah. So different instruments available for securitization. Yeah. So securitization instruments are basically the different ways of issuing your marketable securities from the securitization process. Okay. It can be in the form of Three ways. One is pass through, certificates. Second, pay through securities. And then finally, stripped securities. SS. Okay. So there are three forms of issuing a securitization instrument, students. This is when we talk about SPV issuing securities to investors. This is that leg that we are talking about, students. Clear? So, whenever SPV is issuing instruments to the investors, it can issue in three different forms. One is pay through certificates, pass through certificates, pay through securities, and stripped securities. Now, before we get into this, I'm just trying to put different securities here, and we need to know that what is the underlying of that security. By underlying, we really mean that what is the value driver of that security, right? Which factors or which elements drives value for that security or the pricing of that security. Okay. For example, debt. If we talk about any debt means simple loan, simple, let's say, debentures. So, which things actually derive the debts, or what is the underlying of a debt, students? Come on, tell me. What do you think will be driving the pricing of a debenture or pricing of a bond? Simple.
The cash flows, the future cash flows, it
Perfect.
gives
Perfect. Yes, you're right. The future cash flows. But the future cash flows are dependent on interest rates, right?
interest, yes.
Right. So, interest rate ultimately becomes the underlying. For equity, we have two
Dividends,
things, right? Sorry?
dividends,
Very good. Dividends. So, one is dividend and second is earnings. So all these factors will differentiate the value of the equity. Why? Because earnings. Because sometimes if I earn 100 rupees in a year per EPS, but I will end up paying only 20 rupees in the form of dividend. 80 rupees I have reinvested. So hence I'm taking both earnings as well as dividend. So the underlying becomes the business of the entity in which we are investing through equity. Correct? However, it comes with a fact that there is no fixed commitment. This is all the these are the risky securities, right? Wherever if there is a high gains, that will also be with the equity shareholders. If there are losses, that will also be there with the equity shareholders. Mutual funds. So the mutual funds have NAV, right? Net assets value, whether it is equity or debt, they will be driving whatever is the net assets that is there in the pool of those mutual funds will be governing the value of the mutual funds, right? So the underlying actually becomes the NAV of whether it is in the form of equity or debt. Derivatives. So this might be a new term for some of you. Derivatives is something that we will be discussing in the future sessions, right? But derivatives are also deriving their value basis some of the underlying. Okay, so as of now, I'm just keeping it for the next sessions. We will be discussing these things in detail there. But what I'm trying to build upon here is that each and every security has some or the other underlyings which influence their pricing. Similarly, mortgage backed security, asset backed securities, right? So here what we had mortgage loans, or for asset backed securities it was regular receivables, right? So those will become the underlying of such securities. Similarly, the securities that we are talking about now, securitization related securities. I have not given any name to them. I'm just saying that these are securitization related securities that have been issued. For them, what is the underlying? The underlying is actually the pool of funds or those illiquid assets, right? Those illiquid assets for which the entire securitization process was begun. They are the underlying, or they are the basis for which this entire securitization is happening now. Okay, now let's come to our discussion on these three different types of securities: pass through certificates, pay through securities, and stripped securities. Now let's discuss about the first one: pass through certificates. Okay, now we will take different scenarios, and through those different scenarios we will be discussing about the implications. Okay, there is a borrower, then there is SPV, and there is investor. So what was happening is, borrower, after the securitization process is done, will be paying to SPV through receiving and paying agent or through originator, right? So let's say it ended up paying 100 rupees of principal which was due, 50 rupees of interest which was also due, plus 150 of prepayments. So in totality, 300 rupees are received by the SPV. I hope I'm audible and visible, students. And
Yes. Yes, sir.
okay,
Yes, sir.
clear. So in this case, the borrower is is actually prepaid 150 rupees extra. It can happen, right? In any of the loan arrangements, specifically home loan, you are allowed to prepay the amounts. Okay, so borrower have prepaid it, although 150 was the contractual cash flow, but another 150 is paid as extra by the borrower. So in totality, 300 rupees is received by the SPV. Now, SPV has also further contracted with the investor, right? There is a contract between the SPV and investor through that security that there will be returns that will be passed on to the investor, right? So, now in case of pass through certificates, entire 300 will go to investors in their respective proportions. Because this is a pass through certificate, whatever is coming in to SPV is getting passed through. So this is pass through, right? SPV is just acting as a mediator wherein the funds are coming in and they are going out. Obviously, SPV will be keeping its own commission from which it can manage its own funds. I mean, it can manage its own expenses. That's fine. But as of now, I'm ignoring that. I'm saying whatever is getting received, that is getting passed on. This was case 1. Now let's go to case 2.
And the bank has already taken its share earlier while
Bank would have also
transferring.
taken its share earlier, right? Let's say 0.5%, 1%, whatever it is, that would have gone to the bank. Okay. For our discussion simplicity, I'm just taking the very similar amounts. I'm not assuming that SPV or bank is keeping their cuts in between. Okay. Case 2. Borrower is paying to SPV, and again SPV will pay to investor, which is fine. But now in this case, 100 of principal plus 50 of interest, which is the contractual cash flow, only that has been paid. Nothing extra has been paid. So SPV received 150. We are talking about pass through certificates. In this case, also proportionately 150 rupees will get distributed to the investors in their respective proportions. This is again a case of pass through certificate, students. Clear?
Clear?
So here also what is happening? Whatever it has received, it has passed through. Case 3. Borrower, SPV and investor. Now let's take a example where instead of 100 rupees in principal, only 80 is received, plus 50 of interest, 0 is received. Let's say there is a default that has happened by any of the borrower. It can happen, right? Because you're managing such a big portfolio of loans, there is a default that has happened. Default in payments, total 80 rupees is received. Total 80 rupees is received by SPV because of such Default rupees only 80 received. Now what will this SPV will do? SPV will pay to investors how much? Come on students, tell me. My question to all of you, how much will be paid by SPV to
80,
investors?
80.
Yes, yes. So the answer is 80. In case you are thinking that it should be 150, which is the contractual cash flow, the answer is no, because in this case, it's a pass through certificate. The default in the hands of SPV will again become the default in the hands of investors, right? So tomorrow, if let's say the that 100 crore example that we took, right, that entire 100 crore is not received by SPV. For a moment, let's assume that it's a non-recourse basis arrangement, because if it's a recourse basis arrangement, SPV will still get the funds from bank. So if it is a non-recourse basis arrangement, SPV has to incur losses because of the default, and those losses will be passed on to the investors. In the case of pass-throughs certificates, okay. So this 80 will be released proportionately to investors. Okay, so it is very, very simple. Pass through certificates for investors. Pass through certificates will mean proportionate share in cash flows of SPV. In cash flows of SPV. Clear? So they will participate in the cash flows, whatever that SPV is making proportionately. Simple. Cash flows of investor would be linked to cash flows of mortgage loan held by SPV. Clear?
Clear.
Then the next comes pay through securities. PTS. Okay. Now, again, let's take those examples and let's see what is the difference in pay through securities. Let's take case 1, borrower, SPV, and investor. Now, in this case, borrower is paying to SPV 100 of principal and 50 of interest. These are contractual again. In our previous example also, we have taken 150 rupees as contractual plus 150 of prepayments. Okay. So 100 of principal, 50 of interest, and 150 of prepayments. In totality, this SPV receives 300 rupees. Let's say under pay through securities, there was a agreement between SPV and investors that 200 will be guaranteed cash flows. Okay, 200 will be guaranteed cash flows that was agreed between the shareholder, between the investors and SPV. Clear? Now, in this case, the extra money that has been received by SPV, because SPV will only have to pay 200 rupees to investors, right? So the extra 100 rupees that is paid will be, sorry, the extra 100 rupees that is received by the SPV will be invested by SPV in its own name. Because today the liability, or let's say the obligation from SPV to the investors, is only to the extent of 200 rupees. And that's the real differentiating factor between pay through securities and pass through certificates. Pay through securities will impact only to the extent of the agreed cash flows. Okay. Case number two, there is a borrower, there is a SPV, and there is a investor. So this borrower will pay to SPV. In this case, let's assume 100 rupees of principal and 50 rupees of interest. So the borrower has paid to SPV contractually 150 rupees that they have committed. But now in such a case, the SPV will have to pay to the investors rupees 200, right? This is not going to change. This is going to be fixed. So, sorry. So in such a case, what will happen? 50 rupees will be a shortfall because case 2 I am receiving 150 from the borrower and I have to pay 200 to the investor. So 50 rupees will be my shortfall. This 50 rupees I will utilize from my earlier investment that I did here, right? So those investments are done for this purpose itself. So earlier investment to be utilized to the extent of 50 rupees. Clear?
Clear.
Yeah. So in such a case, the extra, or let's say the equal amount received, will not have any bearing on what SPV will have to pay to the investor. Now let's take the last case here, which is the case number 3 in pay through securities itself. So there is a borrower, there is a SPV, and there is a investor. Borrower has, let's say, paid zero. There is a complete default that has happened. Okay. SPV will have to pay to the investor as 200 rupees. So where SPV will arrange these funds? How much was there earlier? 100 was invested here, 50 was utilized here. So 50 is the only balance from the earlier investment, and 150 students will be borrowed fresh by SPV to give it to the investors, because the cash flow with the investor is fixed. Okay. So this is the real difference between pass-through certificates and pay-through securities. I hope this is clear, students.
Yes, clear. Why are these names given? Pay through securities, pass through certificates. What is the relevance?
Sorry, can you repeat your question?
These names given, pay through securities and pass through certificates. What is the relevance here?
So the relevance is, yeah. So the relevance is, let's say, in any of the finance, let's say, discussions, whenever we use the term of pass through, right? Pass through means that that entity, or in between whatever agent it is not taking any risk or reward on its own. For example, we also say that there is a pass through entity, right? So let's say there is an entity A, it has a subsidiary called entity B, and it has a subsidiary called entity C. Now, entity B in itself is only holding entity C. Okay. Entity C is where the business is happening. The real business is happening in entity C. So this entity B becomes pass-through entity, right? Because ultimately entity C is getting into entity A, and entity B is not having anything of its own. Neither its assets, neither its liabilities, nothing. It is just having investment in entity C and equity from entity A. So pass through is basically used as a terminology where that specific intermediary, in this case entity B, and in our example SPV, these specific intermediaries don't have any of their own risks, any of their own obligations, any of their own rights. They are just acting through some of the other principle, let's say entity A, or borrowers and investors in this specific case. So that is the real relevance of this name called pass through certificates. So it is just a certificate which is giving you a pass through to what borrowers are repaying to the SPV. Pay through securities means that there is a separate right, separate obligation, separate you know separate responsibility of that particular security which is assigned to a particular investor.
Right,
Okay.
right. Yeah, thank you.
Yeah, so in a nutshell, pay through securities is basically cash flows of the investor is not linked directly to the cash flow of mortgage loan held by SPV. Okay. So there is delinkage between the cash flows given to the investors and cash flows realized by the SPV. Surplus can be invested, shortfall can be borrowed. So, students, if you have seen, this was not a specific case for pass through certificates, right?
Yes.
Then PTS securities, what characteristic that they hold? They are having a separate identity from that of the mortgage loan. Okay. PTC, they have same identity of, sorry, same identity as that of mortgage loan. Okay, students.
Yes.
Just a second, I'm just pulling up the study material as well.
So if this is the recourse and the
Huh.
default will be borne by bank or originator, then in the case of this PTS, will the bank bear this loss which they have to borrow? Why would they borrow then?
Sorry, can you repeat the
SP,
question?
yeah, if it is recourse and
If it is a recourse,
the
okay,
bank will borne this risk,
risk, yes,
then why would they borrow? SPV, why is SPV borrowing this amount in
right,
case
right.
of
So in
shortfall?
that case, yeah, in that case, there is no shortfall. So if there is a case of recourse, then we said that here, the in case of this default, the amount will still become 150. That is what they will receive, right? So there is no shortfall then in such a case.
Yes,
So ultimately, I mean, shortfall in this case, it is coming because we have assumed 200 here. Obviously, SPV will also not overcome it what they would want. But in case of recourse, yes, you are right. There will not be any borrowings that will be there. Okay.
yes,
Perfect. So let's do one thing, students. Let's break for 10 minutes. Then we will be covering further aspects on securitization. So I would say let's again join back on 8:37, students. Okay. Uh, we were discussing about the pass-through certificates and pay-through securities. We discussed about what do we really mean between these two different types of securities. Now we will be taking you through that. What is the difference between these two securities? So if we talk about PTS, there is a complete desynchronization between two things. One, cash flows to be paid to investors vis-a-vis cash flows to be received from assets. Okay. And if we say pass through certificates and paid through securities, so in case of pass through certificates, there is no stability in the cash flows, right? There are spikes. In case of PTS, they have stable cash flows securities. There are no spikes. Okay. So this is what the entire discussion around PTC and PTS was discussed in the session. Now let's come to the third type of securities, which is stripped securities. Okay. Now, students, stripped securities is basically stripping out. So, stripping out means that you are dividing into different strips. What exactly? Let's say this is your entire cash flow. 100 rupees of principal and 50 rupees of interest. Okay, that 150 rupees is, let's say, denoted by this block. So in stripped securities there will be a cutting of these two different streams of cash flows to be regarded as PO, which is principal only security, IO, which is interest only security. In our previous example, we have assumed 1000 security at the rate 1 crore each, right? So that has been splitted into PO and IO, principal only and interest only. Now, in a particular EMI, whatever is the component relating to interest will go to the interest only securities holders, and whatever is the component related to the principal will go to the principal only related holders. And both of them can be sold individually in the market. IO can be sold separately, PO can be sold separately. SPV is going to sell IOPO separately in the market. Yes. Okay. IO can be sold to a different investor and PO can be sold to a different investor. So this is SPV. Let's say it has sold IO only to a particular investor and PO only to a particular investor. Initially, the interest rate, let's assume, is 10%. Okay. The IO was priced at 50 and the PO was priced at 100. This is this. Okay. This is just an example. Okay. Now the market interest rate has become 12%. Now, students, comes the interesting part. If the interest rate is increasing from 10 to 12, can anyone tell me what will happen to interest only prices? So this 50 will become what? 50 was equal to 10%. Now, if it has increased to 12, what will be the revised value?
It will increase.
Okay, it will increase, yes. So if 50 was 10%, then what is 12%, right? This is how we will determine
60. Yes.
60. Very good. And what about the principal only value? It was 100 basis 10%, it was 100. Now basis 12%, what will be the value?
It will remain same.
Okay. In your bond valuation, you would have discussed that interest rate is inversely proportional to bond prices,
Yes.
correct?
Yes,
Or I
correct.
can say bond prices is inversely proportional to interest rates. Higher interest rates in market will mean lower bond prices. Lower interest rate in market will mean higher bond price. Correct? With this logic, if 100 was basis 10%, then what will be basis 12% will be given by this formula. 100 into 10% divided by 12%. Sorry. So the price of principal only security will be 83 sorry rupees. It has come down from 100 rupees, right?
Yes.
And the reason is because the prices have increased, which will lead to lower principal only, which is equivalent to a bond price. Okay. Now let's take a reverse example. IO is 50, PO is 100, market interest rate has become 8% now. Okay, it has gone down from 10, it has become to 8. So IO, interest only security, will also have a similar and same impact, right? In the similar direction, 50 into 8% divided by 10%.
62.5.
No, no, 40. It will be 40, right? It will go down.
15 to 8, yes.
Okay. So 50 into 8% divided by 40 with divided by 10%. For principal only security, 100 rupees was basis 10%, now basis 8%. The value will go up.
125.
Yes, 125. Clear? So, with this, what we are trying to explain is that there is a inverse relationship between the interest rates in the market and the pricing of the principal only security. And there is a direct relation between interest only prices and the market interest rates.
But if it is equity,
So, in case it is equity, so okay, generally equity have no relation to the interest rates, correct? Because it is dependent on how the business is doing fundamentally. But equity is also valued from the market standpoint using capital asset pricing model, which is CAPM. Under CAPM, there is a cost of equity, right? Let me explain. Cost of equity is given how? Risk-free rate of return plus beta
beta
into
into RM minus RF.
RM minus RF, right? So this is your risk premium. This is the sensitivity of changes of this particular stock in relation to market, and risk-free rate of return is the interest rate which is carried out on a risk-free investments. So in a way, this cost of equity is actually impacted by your interest rates, and hence your market price of equity is also a function of cost of equity, but it is in an inverse proportion. If cost of equity is higher, the price becomes lower. If cost of equity is lower, the price becomes higher. So it is also inversely related to some extent. Okay, I would not say there is a direct correlation, it is inversely related to some extent. Okay,
Yes, right.
perfect. Now let's take one more aspect of pass through certificates. Okay, let's say principal is 100 crores. There are different mortgages. Mortgage 1 is of 100 crore. Mortgage 2 is of 200 crore. Mortgage 3 is of 200 crore. Interest 5%, 5.5%, 6%. Maturity 2 years, 1 year, and 1 year. Let's say these are the three different mortgages. Okay, the total is how much? 500 crores. So SPV will need a fund of 500 crore. Sorry. So the SPV will raise 500 crore. From whom? From investors, right? Now, if I may ask you that what is the weighted average mortgage rate? The weighted average mortgage rate will be determined by whatever are the individual interest rates of these mortgages multiplied by the respective weights. Correct? So this will be 100 crore divided by 500 crore into 5% plus 200 crore divided by 500 crore, which is the second mortgage, into 5.5% plus 200 crore divided by 500 crore into 6%. So if we solve this, it becomes 5.6 percentage. So this is the income of SPV, right? Because SPV will be getting 5.6%. And from this, let's say SPV says that my operational expenses are to the extent of 0.6%. So 5% is what I am okay to distribute with the investors. So available for distribution will be 5%. And we call this as net pass through rate. Because on a net basis, 5% is what we are passing it to the investors. So this is called as net pass-through rate. I hope all of you understood why zero point 0.6 has come into picture, because zero point 0.6, now for running SPVs, you will need to incur some of the operational costs. So this is for that operational cost is what is being kept aside from the overall interest income. Okay, so that is where the 5.6 is becoming 5, which is available for distribution. Weighted average maturity. 100 divided by 500 into 2 years, right? Because we will also have to determine that what is the maturity of this particular mortgages as a pool. So 2 years and then 1 year both, plus 200 divided by 500 into 1 year, plus 200 divided by 500 into 1 year. So in totality, it becomes 1.2 years. So SPV will propose to the investors a return of 5% for 1.2 years. So overall, this in case of pass-through certificates, we are just trying to explain through these calculations that how it really happens in the real life scenario. Will propose to investors return of 5% for 1.2 years. Simple. Clear, students?
Yes, clear.
Perfect. Now, let me go to the study material and let's cover the part that we have already discussed in terms of the way it is structured there. Okay. So let's come to the different topics that are there. Okay. So first of all, we discussed about the concepts of the securitization, the definition of the securitization, what does it really mean, right? Then there is a separate topic given on features of securitization. The first feature is creation of financial instruments. Now, students, with our understanding, we understood that illiquid assets are getting converted into marketable securities, and those marketable securities that are created is leading to the creation of financial instruments. Right? So, this is one of the features. Then, second is bundling and unbundling. Now, if you see the 1,000 borrowers were bundled together in our example, that is called as bundling, and the issuance of marketable securities, the 1,000 denominated into 1 crore each, that was called as unbundling. So, both the processes are part of securitization, correct? Then, this is also seen as a risk management proposition, specifically in case of non recourse basis. This is a tool of risk management. So, students, you would remember we saw non recourse basis, right? Wherein the risk is with SPV. So, banks use this as a tool of risk management. Then, as we discussed, there are different forms of financing propositions available with the bank. But in this case, the securitization is also giving them a structured form of finance that they can see. Trenching. This is one of the feature of securitization. This is something that we are yet to discuss. I will take it up in the subsequent part of the today's session. Okay, what is meant by trenching? As of now, let's keep it on hold. Then the last part is homogeneity. So within each tranche, again, this is linked to trenching only. So within each trench, the characteristics are homogeneous in nature. That is why homogeneous means they are very similar in nature. That is, there is a homogeneity attached to it. Then, students, we discussed about the securitization process overall. In study material, we can understand what are the benefits of such securitization process, which is again stemming from the same concepts that we discussed. Right, from the angle of originator, I hope all of you understand who is an originator now, the bank. From the angle of investor, the person who is actually investing into those particular securities. Now, the participants are actually classified into two groups. Okay. One, they are called as primary participants. Second, they are called as secondary participants. So, the ones that we are clubbing under primary participants are originator, which actually originates the securitization transaction, SPV, special purpose vehicle, and the investors, right? The investors are the people who buy the securities from SPVs, correct? Then secondary participants are obligors. Okay, so these obligors are whom? They are the borrowers, right? In our example, Mr. A and people like Mr. A who are borrowing from the bank. Then rating agency students, this is what we discussed, right? Rating agencies are the ones who are actually rating on the basis of cash flows, on the basis of credit quality of the obligors, liquidity support, and other things. Okay. Then we also discussed about the receiving and paying agents. So these are responsible for making sure that the accounts are getting serviced, the EMIs are getting received, and these are getting paid. Okay. Then we also discussed about trustees, right? Trustees are the one who are entrusted for the board's governance. Okay. Now there is a term called credit enhancer. So what happens? Credit enhancer is basically the party which is similar to a insurer, right? Wherein the insurance is given in case of any default, the credit enhancer will come into the picture and will make the default good. Okay. And lastly, there is a structurer. Structurer's responsibility is to bring all the parties together and to make sure that there are sufficient agreements, contracts between such parties so that the securitization process is complete. Okay. Then we discussed about the process of securitization, right? What was the process of securitization, students? First of all, we will create the pool of funds, right? First of all, we will create the pool of funds. Then after creating the pool of funds, we will transfer that pool to SPV, and then SPV will create securitized papers, and then they will sell those securitized papers to the investors. Then there will be administration of the assets. Receiving and paying agents will come into the play. If there is a recourse, non-recourse, that will also depend on how they are dealing. And then there is a credit rating that will also be there. Okay. Now let's students discuss about some of the problems in securitization or some of the challenges in problems in securitization. Okay. So first of all, stamp duty. The stamp duty as a tax or as a duty is governed by Transfer of Property Act 1882, and a mortgage debt stamp duty is around 12% in some of the states. It varies from different states to different states, and hence it actually creates issues while it comes to the selling of those mortgages, because then in that case as well the stamp duty implications will come. So this becomes one of the challenges specifically in India. Second is about taxation, right? So whether the sale of loan at a higher or a lower price will create a tax incidence is a question to even some of the tax experts, because the law is not very clear on how the tax has to be treated in such transactions. Accounting. Since these are very complex contracts in nature, so how these has to be accounted for in different parties' books? For example, originator, right? Now there are different elements to the contract which might lead to differences in the treatment of the accounting that they are doing. So there is no standardized way, there is no prescriptive way through which the accounting can also be standardized. Lack of standardization, the fourth point. So lack of standardization means that the originator and SPV can do their over the counter kind of a arrangement which is not standardized, and it might lead to some of the different contracts being agreed to. For example, Air India, I am just telling a very real life example. Air India also attempted one of the securitization process. What they said that we will be taking up the future receivables from our US operations. So, whatever flights we are running from India to US and whatever is going to be our future receivables on that, let's take those future receivables and enter into securitization with the SPV and realize funds today for what we are going to get tomorrow. Although this was not fully executed because of its own limitations, but there are, I mean, this is one of the example on lack of standardization, right? Because till now what we have studied is securitization is only possible for any receivable that is sitting in your balance sheet. But in this specific case, this is a future receivable which is not even generated today. Even on those lines, some of the businesses are trying to securitize, and hence that is making a problem. Inadequate debt market. So if you see India's debt market, the evolved market is not there, which hinders the growth of secondary market for securitized papers to be sold or asset backed securities. Okay, then ineffective foreclosure laws. So what happens? Any loan, it has to be foreclosed. Foreclosed means closed ahead, closed before the final timeline is there. Okay. So because of that, it leads to issues because the law is not very much clear that is there a penalty on the borrower, whether because it will mean that you are sacrificing your cash flows in future, right? And hence your income generation capability for future. It might create mismatches between your future cash flows and what you expect to receive. So these are some of the issues or some of the problems in the securitization process today. Stamp duty, taxation, accounting, lack of standardization, inadequate debt market, and ineffective foreclosure laws. Then students, we discussed about the pass-through certificates in detail, pay-through securities in detail, and stripped securities in detail, right?
Yes.
Perfect. Now let's come to the next part. Although trenching, okay, let me first cover the trenching part. Then we will come to tokenization and other things basically. Tokenization and blockchain is left. Okay, let's first cover the trenching part. Any questions till now, students? Please do let me know if it is clear. Any questions, any queries? I'm happy to take it up. Perfect. Now there was a term mentioned as trenching, which I said that we will discuss. Okay. So I'm just briefly explaining you what is meant by trenching. So trenching is coming from tranches. Tranches means different levels, right? Different levels. Now what happens, students? Senior, mezzanine, and junior. Okay, so these are the three different tranches through which the names have been defined. Okay, now rather than going into the names, let me explain you briefly what does it really mean. So in a company, there are different types of security holders. There is a equity shareholder. There can be a preference shareholder. There can be a debenture holder. There can be a debenture holder, right? Now, there are different risks and reward for these three different levels, correct? These are also three different levels, right? So, equity shareholder will have the highest risk and the residual reward, right? Similarly, preference shareholder will have medium risk but fixed reward, right? They will have fixed reward. Debenture holders will have lowest risk and fixed reward, correct? Because here the percentage is fixed. Preference shareholders, the dividend is also fixed. Equity shareholders, there is no dividend that is fixed, right? So these three different level of people are actually creating the differences in the way they have rights and obligations with the company. And hence, in securitization terminology, these are these three different people: senior, mezzanine, and junior, right? That we have discussed above. So just imagine that a group of investors having no risk with fixed return. They are one set of tranche. Second set of tranche are the one who have medium risk, fixed return. Third level of tranche is having very high risk, very high return, a possibility of very high return, at the same time a possibility of no return also. So there is no fixed return. Clear? So that is where the tranches are part of the securitization process. Clear, students? So they have different rights and obligations attached to their differences in the way they operate. Clear? Ultimately, what happens that the investor's choice will also determine in which specific area or in which tranche they would want to get into. If they would want to get into a risky one, they will choose the respective tranche. And that is where we said that in features of securitization, trenching is one where the homogeneous groups belong to, right? They have a similar risk and reward. Now let's discuss about blockchain. Anyone would want to share their thoughts? What do they mean by blockchain? What is their understanding about blockchain, students?
It's used in cryptocurrency.
Okay, this is one. They are used in cryptocurrency. What is the other thought, students? What do we mean by blockchain as a technology? So cryptocurrency revolves, yes, cryptocurrency is very much a linked concept here. But apart from that, what is really the operating philosophy of this technology? Okay, let me explain. It is made up by two terms. One is block and second is chain. Block means a block of something. A block of something in this case will be a block of information, right? This is, let's say, a block. This block, let's say this is block 1, unique number is block 1 and it is containing some details. Similarly, there is block 2, it is also having some details. Okay. Similarly, there is block 3, it is also having some details which is definitely in relation to what is contained in block 1 and block 2. Then let's say block 4 and so on. It can be multiple blocks, right? So there are different blocks, block 1, block 2, block 3, block 4. They will contain some information about something that we will see what it is, and they are all linked through chain. So block 2 is linked with block 1 through a chain. Block 3 is linked with block 2 with a chain. Block 4 is linked to block 3 with a chain. Similarly, further blocks are linked to such blocks above through a chain. So it is a chain of blocks which is accessible to users. Okay. So first of all, these blocks are visible to the users, and they are going to be million of users who are on their network. So assume like this, in your offices, you would be working on an Excel sheet. You can share that Excel sheet for simultaneously changes with the other users as well. So let's say there is a single Excel sheet on which multiple users are working, and they can make changes at the same time, right? So these blocks are those where the users can change. But what happens if they try to change it? A new block will get added with the amended details. So so basically the block that contains the information cannot be changed per se, because there is a proper sequence, there is a proper trail of who has changed, what has changed, and a new block gets added. So this is also called as distributed ledger technology. This is called as DLT, distributed ledger technology, right? Distributed ledger technology. Why distributed ledger technology? Because million of users at the same time can view and change these set of information. Clear? Now let's take a use case, how these blocks are used, right? Let's say there is an Indian company. and there is a Australian company. Indian company needs to send funds to Australian company. Let's say the value is $100. A block will get added to one of the existing blockchain in which it will be mentioned that India, this specific company is paying to Australian company. Balance before payment was, let's say, $200. Payment is happened on $100. Balance after payment for both the companies is, let's say, 300 and 400 respectively. Sorry, 100 and 400 respectively. So entire information will be there, and this will be simultaneously visible to Australian company and Indian company and even other companies who are part of this network. And then further blocks will get added. So they will know that the information which is put it in a block is actually verified by even the Indian company and the Australian company, and they agree to what is mentioned in the block, and hence it keeps on adding to the other chains. Okay. So yeah, if I may say, so if we see what is really turning it out to in terms of the this specific transaction. So the transaction here is of sending the money to someone. So first of all, what has happened? The transaction is broadcasted. Broadcasted means published. Published via the network, right? The network of this blockchain. In this, the information is published that the money is sent. The network in which this block is getting added will validate the transaction using cryptography. Okay. Cryptography will be used to validate the transaction. Then once it is cryptographed using cryptography, it is validated, it is added, represented as a block. Then it is represented as a block, and then block is added to the existing blockchain. Added to existing blockchain, and then once it is added, it is freezed, it is completed. So the transaction is complete. Now this has multiple uses, students. One, just now we saw in case some payment needs to be made. Second, it is very much useful in the sector of financial services. So let's discuss about some of the applications of blockchains, right? Where it can be applied. One, financial services, right? So now let's say there are many transactions that are happening. Now let's say there is a UPI, right? There are some of the asset sale purchase transaction that gets recorded. So all of these have different life cycles, right? They have different data elements. All of them can be applied for using a blockchain in the financial services sector. Second, healthcare. This is an important one because in case of healthcare, the sequence of reports, or let's say the diagnosis, even the medical history, can also be kept in a proper form using the blockchain technology. Government government can actually use blockchain technology for many aspects because government is also handling huge amount of data. One is vehicles, let's say vehicle registration, land registrations, management, e-voting, other things. So all these things can be used, the blockchain technology can be used to link this. Similarly, travel industry. Here the information pertaining to, let's say, visas, passports can also be stored using the blockchain technology. Then similarly, some of the forecasts, right? How these financial and economic forecasts are actually impacting. If these are already analyzed and kept by the government, the blockchain technology can be used to strengthen the sequential events associated with the forecasting. Okay, but there are certain risks that are also associated with using the blockchains, right? We should be aware about those risks. Any questions till now, students? Please do let me know. Now, the biggest risk is basically since there are many members of such network, the responsibility cannot be fixed, right? And hence it becomes the biggest risk for multinational corporations where they feel that they don't know who is the face with whom we should deal, right? And the accountability is not achieved. Who is the party in charge? Where is the accountability lying? Because this is a ocean of million of users, right? Which in which there is no responsibility that is getting fixed. Then the entire network is built by the technology, right? The blockchains is nothing but the technology. So if somebody hampers the technology or somebody plays around with the technology, it can really hamper the information that is also contained in the technology, right? So this is the second biggest risk, that somebody can change the technological aspect leading to these issues. Then, just like banks are governed by RBI, insurance is governed by IDA, right? Similarly, in this industry, there is no centralized governing body to administer to administer their operations, to define some of the protocols. So this is also one of the risks. See, absence of central authority. This makes a risky move. Then it also, blockchain in its entirely is also dealing with humongous data, right? Which will lead to, let's say, some of the controls being hampered with, right? So these are some of the risks that are associated with the concept of blockchain, students. Yeah. Any questions, students, till now? Okay. Then we come to the next concept of tokenization. So, tokenization, for understanding tokenization, we need to understand what is meant by the blockchain as a technology, right? So, should anyone would want to attempt what is meant by tokenization? Yeah, students, we are actually discussing the topic of securitization. Within that, there is a concept of tokenization. Is it not somewhere linked? Can we not link it? Yes, we can link it. So, what is tokenization? Tokenization is a process of converting tangible and intangible assets into blockchain tokens. I think some of you might have heard in the news that, let's say, there is a very expensive painting, there is an expensive artistic creation. Instead of selling that in a physical form, that is converted into a blockchain token and it became a digital asset. And now that digital asset is being sold or purchased. So it is converted into tokens, right? So it is digitally representing anything that has recently acquired a lot of traction.
Yes, it is called fungible tokens.
Yes, you're right. Okay. So what will it mean? Now those tokens can also be traded, and this process of converting these assets into some kind of digital security is called as tokenization. What is securitization? Securitization also, you are converting the asset, the illiquid asset, into marketable securities. Here you are converting the tangible and intangible assets into such blockchain tokens, and then you can deal or trade in such tokens. Clear, students? So, tokenization of illiquid assets is basically converting them into a product that is liquid and tradable. Okay, and hence it to some extent resembles the process of securitization, because securitization also we are converting it into marketable securities. Here we are converting to digital kind of securities, right? So now what are the similarities between tokenization and securitization? So first of all, liquidity, right? Both of them is helping in liquidity by eliminating the illiquid assets, by eliminating the characteristics of non recoverability, or let's say non realization of cash portion in both the ways, right? So it injects liquidity in all aspects, right? Then diversification. Through liquidity or through marketable securities, both tokenization and securitization helps people to diversify, the investors to diversify, because no one would have ever imagined that a retail investor could also invest in the bank loan given by bank to Mr. A. Right now, those pool of funds are also available for the investors to invest. So it is leading to diversification. Then obviously they can help in trading, right? the securities that are created are tradable. If it is tradable, that means people can enter and exit the time that they would want to do so. And sorry, both of them, sorry, both of them are providing new opportunities. These are all new age opportunities to the financial institutions. Sorry, and even to, let's say, the people who want to invest, right? Obviously, in our all discussions, we discussed that somewhere they will be earning, somewhere they will be keeping the margins that the intermediaries will do. Then, I think, lastly, the securitization specifically in India, how it is relevant for us is basically, sorry, so through one of the law, the securitization is governed in India, which is securitization and reconstruction of financial assets and enforcement of security interest. So this is called as SARFAESI, Sarfaces Act, which is basically dealing with the securitization and reconstruction of the financial assets and enforcement of security interest. Clear? Now, in this case, there are different things that are prescribed that in case a non-performing asset is to be tackled with, then what are the things that has to be kept in mind, right? Similarly, now if we talk about today, right, how has securitization volumes have been? So you can refer the study material as well, but just to give a glimpse, it has picked up good traction from, let's say, financial year 16 onwards, 16, 17, 18, 19, 20. So financial year 20 and financial year 19 actually saw the highest amount of securitization volume in terms of the USD dollar billion revenue, right, which is 26.49. And as I discussed with all of you, right, some of the cases on uh, Air India, let's say, right, they also attempted a different kind of a securitization while we were discussing about the issues or, let's say, problems of securitization in India. So, students, that was it from my end. Now, let's do one thing. Let's do a quick revision, right? And I can take in between if there are some of the unanswered, let's say, questions, or in case you feel that something you want to pick it up for discussion, that we will do. And post that, we will also cover some of the MCQs from the today's discussion, which I would want all of you to please respond. Okay. So let's start with what we discussed. So we started our discussion on the topic of securitization through one of the example wherein Mr. A has taken a loan from bank, and it is in the nature of 25 years home loan. It is converting the bank's liquidity into a liquid asset because the realization will be happening over a period of 25 years. Through this arrangement, bank's earning potential got limited because they will not be able to earn beyond the committed amount what they have paid here, right? So just to increase their ability, what they did, they came up with a concept of securitization where they sold these assets, right? Assets in the form of a bank loan to a SPV, and they realized the funds. After realizing the funds, they lended such funds again back to the fresh borrowers. Borrowers were called as obligors, right? So Mr. A, while taking a loan from bank, promises to repay the principal and the interest. So in a way, loan from the bank's point of view represents the right to receive interest and principal repayments. Then we introduced other parties to this, where we said that let's take a pool of funds which comprises of all such illiquid assets. The bank will trade these assets with SPV and realize the amounts today. The SPV will raise funds from different parties who are interested to invest in such propositions such as pension funds, mutual funds, bank, institutional investors, and others. They will convert these into different securities, into different marketable securities, and they will sell such securities to the investors, where investors will go and subscribe such securities and they will put the amount into the SPV. So the entire process had converted illiquid assets into marketable securities. Illiquid assets was referred to the pool of funds, the mortgage loans. They got converted into marketable securities, and hence it helps in the injection of liquidity into the entire financial system, right? This is how it is called as the securitization process. Then comes the mortgage backed securities. So, mortgage backed securities are the ones which are basically backed up by mortgage loans, and those securities are issued under the process of securitization process, right? And asset backed securities are the ones which are still part of the securitization process, but as a underlying they hold other than mortgage loans, for example automobile loans, other receivable, credit card receivables, all those things. Then we discussed about the concept of recourse and non-recourse, where we said that recourse is a situation where SPV can get back to originator in case the borrower defaults. So the recourse is basically a beneficial option for SPVs because they are not undertaking any risk of non-collections. In case of non-recourse, there is no entitlement to the funds from originator in case the borrower defaults, and hence the risk of non-collection lies with the SPV. So the pricing of this loans that SPV is purchasing would really depend on what is the recourse and non-recourse related adjustments which they will definitely be doing in their respective areas. Then students, we said that the entire securitization is not only between borrower, originator, SPV and investor. There are other parties to it. And why these parties are needed, we also discussed that. The role of receiving and paying agent is very much important because they will be maintaining the entire service book, or let's say the entire collections book for the future collections from the borrowers. They will maintain that what is due, what is not due, who has paid how much, and they will remit the amount back to SPV so that the collections are distributed in the investors. Similarly, investors for investing into this proposition will need assistance of credit rating agencies and credit enhancers. The other party also we discussed, right? So the credit rating agencies, their prime responsibility is to evaluate, assess, and provide an overall conclusion of what is the rating of such pool of assets. Now, this will, while doing this, they will take into account the profile, the credit profile of the borrowers or the obligors, and hence they will be coming up with what it should be. Basis that investors will get confidence and they will be able to judge that where they are able to enter into a highly risky proposition, low risky proposition, and how they will be able to navigate through different return scenario. We also said that mostly SPVs are in the form of trust. If they are in the form of trust, trustees will be governing the operational part of these trust. Credit rating agencies, if they are saying that the credit rating is good, the risk becomes low and the return also becomes low. If the credit rating is not good, which is bad or ugly, then the risk will be higher and the return expected by the investor will also be higher. Then this was an important discussion where we discussed about the securitization instruments. wherein we said that there are three different types of instruments. One is pass-through certificates, PTS, PTC, pay-through securities, PTS, and stripped securities. This is when we deal from SPV to investor, that layer. We discussed about different securities, what are the different underlying, what are the root causes of why the prices move to what it is. Here the important ones were these scenarios, right, where we said that whatever may be the cash flow that is coming from a borrower to the SPV, the same will be paid from SPV to the investor proportionately, right? So there is nothing of that sort wherein the separate arrangement between SPV and investor will call for separate amounts to be paid. So it is just acting as a pass through SPV, right? Where whatever amount is received will be paid to the investors proportionately. If it is a shortfall, the amount will go less. If it is higher, the amount will go higher. Okay. Then pay through securities. Pay through securities, there is a total desynchronization between what is being received and what is being paid to the investor. So both the elements are quite different, students here. Then we discussed about the differences between these two. We said that PTC there is no stability, PTS there is stability. PTC there are spikes because if a borrower prepays amount, it will be passed to the investors. In PTS, if borrower prepays an amount, it will be parked in the form of investment and will be utilized later once the default has happened. Then this was very important one, students, where we discussed about the stripped securities, where we said that cash flow is actually stripped or broken down into different pieces. In this case, one is principal only, second is interest only, and SPV is going to sell the interest and principal only securities separately to separate investors. Both of them are linked in a different manner to the interest rate movements. Interest only securities is directly proportional. If interest rate increases, interest only security prices will also increase. And principal only securities is inversely proportional to the interest rate, where if interest rate increases, principal only prices will decrease. This we explained through these examples. This was one of the things that we discussed, that how overall interest weighted average rate, weighted average maturity is being calculated. Then obviously features of securitization, participants, primary and secondary, basis whatever we discussed came in. Problems we discussed, what are the issues currently on securitization process that are hampering, when is stamp duty, taxation, accounting, lack of standardization, inadequate debt market and ineffective foreclosure laws. Then we discussed about trenching briefly, right? We touched upon this. Then obviously the blockchain technology, which we just now discussed, that blockchain is adding the block to a chain through this technology, which is called as blockchain technology. Some of the use cases we said that apart from making payment, financial services, healthcare, government, travel, and economic, wherever the huge data is being handled, there the blockchain technology is being widely used. Then there are definitely some of the risk of tampering, member network identity not verified, central authority not being there, and then humongous data. And then tokenization and its relatability to securitization, right? There is similarity between the tokenization and the securitization as a process. Yes, students. Now with this, we come to the MCQs. Now I would suggest that all of you should either type on the chat about what are the answers that you feel that we will discuss about these MCQs. Okay. So the question number one, let's start with question number one. A bank has a large portfolio of home loans and wants to reduce its credit exposure while raising funds. It decides to transfer these loans to an SPV, which issues securities backed by the loan repayments. What type of financial transaction is this?
Securitization.
Yes, I think I am receiving options on the chat also. Chitra, you're also right. And yeah, um, you're also right. So it's securitization, it's an easy one. What is the primary purpose of securitization? To increase the interest rate on loans, to convert illiquid assets into liquid securities, to reduce the number of loans in the market, to increase the tax liability of originator.
To convert illiquid assets into liquid securities.
Very good. This is the right answer. And Chitra, your answer is also correct. In case, yeah. Then question number 3. Which entity issues securities in a securitization transaction? Is it
SPV,
originator? Is it servicer, special purpose vehicle, or credit rating agency?
special purpose vehicle.
Vehicle, yes. So this answer is correct. Chitra, your answer is also correct. Tranching in securitization refers to pooling of assets, which is bundling, dividing securities into different risk classes, selling assets to SPV, enhancing credit rating. We just now discussed about, briefly touched about the concept of tranching.
Dividing securities into different risk classes.
Yes, so this is correct. This is dividing securities into different risk classes. Then question number 5th, XYZ Bank securitizes its auto loan portfolio. Now they're talking about auto loan portfolio. The SPV issues three tranches: senior, mezzanine, and junior. During an economic downturn, default increases. Which tranche is likely to absorb the losses first? Come on, students. So it's about that which tranche is likely to absorb the highest level of risk, which is actually junior. Okay.
Okay.
Question number 6. An investor is evaluating a securitized instrument backed by credit card receivables. The instrument offers high returns but is rated below investment grade. What is the most likely reason for the high return? So we discussed this, right? Higher return will mean what?
High risk. High risk.
Yes, it will mean higher risk. Correct? Because if, let's say, the credit rating agency evaluates that the risk is higher, definitely the investor will expect a higher return on that. Now, these are some of the MCQs basis the case study. So let's go through this. Growmore Limited sold its receivable worth rupees 100 million to Mac Financial Corporation MFC.
Diva sir.
Yes, sir.
Okay. Correct. No problem. Please continue.
Okay, sir. Yeah. So Growmore sold its receivable worth rupees 100 million to Mac Financial Corporation. MFC created a trust named General Investment Trust to facilitate this transaction. GIT issued securities to investors, each carrying a different level of risk and return. Okay. GIT also collects payments from obligors and follows up on default. Okay. So this is the case study. Now they are asking us to identify certain parties. The securitized instrument issued for rupees 100 million by GIT falls under which category? This is a tricky one. Now, if you read the case study carefully, you will be able to understand whether it is pass through certificate, pay through security, stripped, or debt fund. Come on, students. Why? I would need to understand if you are choosing which option and why.
It is pass-through certificate.
Why? Why do you feel so? It is pass through
There are
certificate.
different levels of risk and return because it will vary. The returns will vary. Everything will be passed on to the investors, whatever they.
No, but the question is not, the case study is not saying that everything will be passed to the investors. It is saying that it will have a different level of risk and returns, right? So the different level of risk and return between what they are receiving and what they are paying will actually create this as a pay through security, right? The question is not indicating that whatever is you're getting is getting passed through. Okay, so the correct answer is pay through securities. Now, in the above scenario, who is the originator? This is a straightforward one. Who would you call as an originator?
Bank.
Yes, which bank? In this case, who has been in
Mac Financial Corporation.
no, Mac Financial Corporation is the one who is receiving the receivables, right? Here the receivables.
Gromor Limited.
Yeah, so the Gromor, I think Chitra, you have also responded. Your answer is also correct. The last question is, which of the following statement is true regarding principal only securities? When yield to maturity rises, sorry, I should not put it. Yeah. When yield to maturity rises, PO prices rise. When yield to maturity rises, PO prices fall. When yield to maturity falls, PO prices fall. PO prices remain constant regardless of yield to maturity. Come on, students. This is an easier one.
When YTM rises, PO prices fall.
Yes. So this is the correct answer. When YTM rises, the PO prices fall. So I think this is it from our discussion today on securitization. Now I would request C. Ashish sir to please help with the concluding remarks. Thank you, sir. Thank
Thank
you.
you, Divas sir. Your session was very encouraging, and actually, when I was since I didn't put up the specs when you were reading the
Sure.
case study, since you had divided into the lines, so I thought the slide is not moving. That's I got
Okay.
out from.
Okay, sir. Okay, sir. Okay, sir.
So
No
anyway,
worries.
that you are present and a student has made make it very interactive, and because the response from the student also contribute a lot in the success of these classes. So
Right,
students,
sir.
with this we have come to the end of chapter number. This is chapter number 7.
7.
Okay, so chapter number 7 we have up to chapter number 7 we have completed. Now in the next class we shall start with the chapter number 8, that is mutual fund. So in the basically this topic is a more theoretical, we can say theoretical oriented, and generally theoretical questions are asked from this topic. Of course, this topic is very important nowadays because I think Devasa, you must have discussed the case of Citibank.
No, sir, we can discuss that. You can sir discuss that.
Actually, in India, if we talk about this securitization, the process somewhere has come around 1990s. When I think Divas sir must have, no, even Divas, you must have not born
Yeah.
at that time.
Yeah. Right. Right.
So 1990, there was a car Maruti 800. Okay, so at that time, basically the vehicle loan was used to be financed by the public sector banks. Okay, and they involve a very guarantee, long procedures, etc. there. Now, I think it was a Citibank or by the name of Citicorp. They have come into the business of this granting the loan. There was, I think, they were first private lenders. So what they did, they issued the home loans. There's a vehicle loan to maximum people, seeing there's some criterias like income, etc. And they have start financing Maruti 800. Now everyone was worried ki why they are taking this risk. So what they have done, whatever be the loan amount in the form of receivable they have shown in their balance sheet, they have created a SPV and ultimately they have issued a security for the same. So this was the, I think, first time where the securitization has come into the picture in India. Nowadays, NBFC are the main sources of this securitization because they give a very small loans, and they ultimately what they do, they convert them into the small tranches. So am I correct, Divas sir, if you may have a practical knowledge of this?
Yes, sir. Yes, sir. Yes, sir.
NBFC are
Yes,
the
sir.
major player in this
In
securitization
the
field.
securitization, yes.
So securitization is very important from the practical point of view as well. Whenever after qualifying your CA, it may be you may face the question on this topic as well. So student, with this, thank you very much. Devas sir, just share your screen and share
Sure,
our
sir.
telephone number.
Sure, sir. Sure, sir.
Okay, I do it. I do it on a chat. No problem. I think I can.
Sure, sir.
I do it by chat. Don't worry.
Sure, sir. Sure, sir.
Because it is customary, although the student are aware about the same. Okay, this is my this is our email ID. Okay, or if you have any query, you can contact us through the telephone. Okay, 0120 is Noida STD code. Okay, so you can. Okay, student, thank you very much for patient listening, and thank you, Divas sir, for
Thank
sparing
you,
your
sir.
precious time and letting the student know the same topic. Thank you very
Thank you,
much,
sir.
and have a
Thank you,
nice
sir.
day.
Thank
Thank
you.
you.
Thank you, sir.
Thank you. Thank you.
Session over.